Well, good morning and welcome, everyone. It's Jim Brett at the New England Council. Hope that all of you are remaining safe and healthy. Today, the New England Council's Financial Service Committee is very pleased to welcome back a very good friend, Tom Curry. Many of you know was the former comptroller of the currency for the United States, and we're grateful for his time today. Please know that we're also continuing to work with the New England Congressional Delegation and area business leaders to continue our Capitol Hill Report programs. And some of our upcoming events include the Capitol Hill Report with Connecticut Congressman John Larson on April 20th, on Monday. A First Responders First, a briefing with the Dean of the Harvard School of Public Health, Michelle Williams, on April 22nd, and a Capitol Hill Report with New Hampshire's Congresswoman Annie Kuster on April 23rd. But we're very, very pleased to have Tom Curry here today. Many of you know he was the comptroller of the currency in 2012 to 2017. Many of you know that the responsibilities of the comptroller supervise more than 1,400 national banks and federal savings associations and about 50 federal branches and agencies of foreign banks in the United States. These institutions comprise nearly 2/3 of the assets of the commercial banking system. Comptroller is also a director of the Federal Deposit Insurance Corporation. And before becoming the comptroller, a good friend, Tom, has served as director of the Federal Deposit Insurance Corporation beginning in 2004, and also having served under 5 Massachusetts governors as the commissioner of the banks for the Commonwealth. Many of you know now he is a partner at Nutter, McLennan and Fish, and we're just very pleased to have him here. He will give us his insight on how the COVID-19 pandemic has impacted financial service industry and what the recovery process may look like in the months ahead. Additionally, he will be going over some of the well-known CARE Act and any future policy benefiting the financial service industry during this crisis. Then we'll be asking him some of the questions that you all have either previously submitted or have asked during the webinar, which will be moderated by Griffin Doherty, who heads up the Financial Service Committee. You can type in your questions during the Q&A feature on your Zoom screen at any time. So with that, I thank all of you again for taking time to join us today, and in particular, our guest speaker also. Pleased to turn it over to our good friend, Tom Curry.
Thank you, Jim. I appreciate the kind introduction. It was a pleasure working with you during my career in Massachusetts. I want to start by talking about how this crisis, economic crisis, is similar and different from the global financial crisis that I served in the federal government, either as comptroller or as a member of the FDIC. I think certainly the steep drops in the global financial markets that we've seen, the growing risk of a deep global recession, bring back some of the memories of the global financial crisis. And hearing some of the unemployment filing claims today, the fact that we've had within 1 month over 20 million claims for unemployment, this crisis may be more severe than the last. While they're similar, I also think there's some differences. The financial crisis was the direct result of excesses within the banking and larger financial system. Here we have a crisis that is really a biological, caused by a biological pandemic. That actually, I think, makes it more significant, more troubling than the last crisis, because we don't know its duration or our capacity to treat those who are afflicted by it. And in most financial crises, until there's an understanding of when and how something will be controlled, you cannot really have an upward swing. So here, I think in this particular financial crisis, we've got still have the uncertainty and lack of reliable information that will allow us to go forward. The other thing that I think is different today than the last crisis is that regulators and policymakers actually learned something from the last one and how to manage a crisis. And I think number one, lessons learned, we're building up the banking sector's strength, resilience, so that they can handle stress situations like we're seeing today. And another one which we've seen happen, to not delay using all available monetary and fiscal firepower to stop the initial free fall. And again, I think Treasury Secretary Paulson said it best back in the last crisis when he said you need to pull out the so if you look at the banking sector today, the regulators, both during the crisis and after Dodd-Frank, really mandated significant increases in the industry's capital, reserves, and liquidity. And those efforts included improving the quality and quantity of the capital, raising minimums, and imposing additional capital and liquidity buffers for large banks. And again, I think an important lesson learned from the last crisis was the need to impose rigorous annual capital and liquidity stress tests, such as the CCAR exercises. And then, what I did as comptroller, also demanding that larger banks have heightened standards for risk management and corporate governance. So just to compare, I think today we have substantial levels of capital and liquidity that basically are almost double what they were at the start of the last crisis. So we have now $1.3 trillion in common equity and almost $3 trillion in high quality liquid assets that have served as a buffer during this pandemic impact. Again, going forward, I think the Fed has been very good in rolling out emergency liquidity facilities under Section 13.3 of the Federal Reserve Act. And basically, I won't go into great detail, but what they've done is they've dusted off some of the liquidity facilities that took several weeks to develop during the last crisis and rolled them out immediately. And that helped relieve some of the tension and liquidity issues in the primary dealer market, the commercial paper market, and the money market funds. What's interesting is that the Fed, within the last 2 weeks, have launched newer funds or expanded funds that deal with other areas of the credit markets that have seen some liquidity squeezes. And just last week, I think two important programs were rolled out. One is the liquidity facility for the Paycheck Protection Act under the CARES Act, and also the Main Street business lending programs. And what I'd like to flip to and then talk about is really the CARES Act, $2 trillion worth of stimulus funding really was rolled out very quickly, unlike what we saw during the financial crisis, where it took a precipitous drop in the stock market for the Congress to actually approve the less than $1 trillion TARP Act funding. Here, Congress joined in with the Treasury and the regulators in seeing the need to put as much firepower out as possible and as quickly as possible. And the initial strategy of trying to mitigate or offset the employment impacts of the pandemic and the emergency closure orders by states and local governments really is initially an effective strategy, notwithstanding the fact that we are seeing substantial levels of unemployment. The issue going forward is really going to be the timing issue. The CARES Act, I think, could be viewed as a an initial effort to stem the downward spiral economically of the crisis. The issue is going to be is how long will its ameliorative effect last? And at some point, unless we get people back to work, we're going to start to see a more permanent or significant impact, particularly on banking institutions. These are all, I think, short-term remedies, and until the economy starts again robustly, you're going to start to see some credit quality issues with some of the bank's consumer and business borrowers. Certainly, the regulators have initially offered a level of forbearance. All the regulators have come out and said the need to prudently work with your customers. The CARES Act has protections for eviction and mortgage loan forbearance, federally insured or issued backed mortgages. These things, again, will expire. And then the issue will be is, do we have sufficient enough capital within the banking system to absorb any future credit issues, asset quality issues. Another forbearance-related action that's occurring, and again, it's almost a direct effect of the pandemic itself. The regulatory agencies really are not actively examining financial institutions. That will delay any, for at least a period of time, any potential regulatory directives after they get to examine the effect of the crisis on individual loan portfolios. Again, I think that this time around, the Congress, the administration, and the regulatory agencies, particularly the Fed, are working together and really to try to stem some of the more adverse impacts of this type of pandemic-induced slowdown. That's my basic overview. I'd be happy to answer any questions from Jim or from the audience through Griffin.
Yeah.
On any subject.
Good. Griff, do we have any questions yet from our members?
No questions just yet. So I encourage people that are listening, you can either email me if you're calling in or use the chat question and answer feature on your computer. But one question that I think a lot of folks are interested in is, given the confusion about when the country or individual states will be individually opening up. I know the president says large groups of states could be opening next week, while other governors of states are banding together to be on the same page. Could you talk about the possibilities of how that might impact some of the banking industries or the financial industry if different states are opening for business at different times?
I think number one, there's a need to have a planned and programmatic launch or relaunch of economic activity. That's going to be important to the banks to restart, to have businesses that they are lending to resume business, hopefully at a steady clip. I think, just from a pandemic standpoint, it will have an adverse effect on the economy, which will affect the banking industry. If we have false starts and are required to have to reissue, lockdown or emergency declarations, that'll just prolong the pain economically and personal health-wise going forward. So again, we need to get the economy going. It needs to be sustainable and well thought out. That'll ultimately benefit the economy and individual banks.
Great.
Tom, I just read the Small Business Administration said it was unable to accept any new applications for the Paycheck Protection Program because so many applicants have already sought loans in the past couple of weeks. And apparently the Republicans and the Democrats are going to be calling for additional money for the program. Your thoughts on any new initiatives that should be thought by these members of Congress or the FDIC or Federal Reserve that have not already been entertained? Or do you think it should be just continue doing what we're doing, give more money to the SBA loans, or are there other things that should be contemplated as we try to get out of this crisis?
Yeah, let me talk a little about the Paycheck Protection Program. I think what it's trying to do is laudable. It's basically trying to provide an immediate lifeline to small businesses. And as we all know, small businesses really are a big driver of employment and the economic activity. So it makes sense to have a program launched quickly that puts money in the hands of small businesses. The program's designed to ensure that, in terms of loan forgiveness, is designed to ensure that payroll levels are maintained and that the funds can also be used for other operating, 25% of it can be used for other operating expenses to get that total loan forgiveness. I think there were a couple of things that probably were foreseeable but unavoidable. It was structured as, if you can have loan forgiveness, it is effectively a grant program, but it was structured under the SBA as a loan program. I think there were probably political and policy reasons why it had to be a loan, but that created, I think, some operational obstacles and delays. You have to look at the SBA. They do great work, but their annual volume, I think, last year was under $30 billion worth of SBA loans, Section 7A loans. What this program did was basically force a $350 billion program through the funnel of a $30 billion process, and I think that has been, we've seen over the last 2 weeks that the program has shifted almost on a daily basis in terms of terms and conditions. Again, I think the SBA and Treasury have been good in terms of issuing pretty rapid fire clarifications through the interim final rules and FAQs. But again, this was kind of foreseeable. The Treasury announced they'd be accepting applications 1 week after the CARES Act was signed. To expect the SBA to be able to launch that, I think, was unrealistic. Again, I think the fact that we've run out of funds within a week's time, 10 days time, just shows the magnitude of the problem. And I'm sure you've heard, Jim, the administration at least is banding around the number of another $250 billion to the program. That's right. A small change, but it goes again to show the importance of small business and the appetite for these loan/grants under the PPP or Paycheck Protection Program.
Yeah, I mean, there are some 30 million small businesses in the United States, and I read somewhere where the SBA has approved 1,637,000 loan applications. So they have a long way to go, and I think the debate now is how much more are we willing, both sides, to give to this program?
Yeah, and I think that's I think there's a willingness to do that because of the impact of small businesses. But again, 2020 hindsight, I think the money could have gone out quicker if it was done as a grant program as opposed to a loan program. Of course, the advantage of doing it as a loan program, the SBA and Congress were able to tap into the community banks and large banks network of SBA lenders. So a lot of processing of these applications or loan applications were done, in a fairly efficient manner by experienced lenders. One of the interesting things about the program, and I've had an interest in fintech since being comptroller. It was interesting that the program, the Triple P program, allowed non-SBA lenders, non-banks, to participate under certain criteria. And that I think is a significant policy shift. Unfortunately, from the fintech perspective, that process again, proving them to be direct lenders, was very slow. I think only the approval started only a few days ago, and now we've seen that the spigot has been turned off because of a lack of funds.
Right. Well, as you already indicated, I think some 22 million people have already filed for unemployment benefits just in the last 4 weeks. Do you think that this high unemployment rate, they're talking almost 10%, that could last throughout the year, as even though the economy may be reopening in different parts of the country in the next couple of months? Do you forecast double digit as high as 10% unemployment throughout the whole year?
Yeah, I think it's going to be all dependent on how fast we're able to, test, reassure people that it's safe to come out and work and to spend. And until that happens, there will be a lack of economic activity. So, I'm not a public health specialist, but I do think until there's a comfort level by businesses and individuals, we're going to have employment impacts and an economic impact. And employment levels will get worse if there is no quantifiable end in sight or the ability to resume business at some level. And I think that's the first step. And industries are going to have to reassess and potentially retrench if they don't see the necessary preconditions in place to resume business.
Okay. Any other questions, Griff?
Yeah. Folks just wanted to get your thoughts on pandemic risk insurance and how that might affect the insurance industry, but also benefit the small business industry. Obviously, a lot of people might be applying for that if some sort of agreement is brought up in Congress to benefit the small businesses or people that are impacted by all this. But obviously, it could have a negative impact on the insurance industry. It'd be great to get your thoughts on that.
I'm not an expert on insurance, but I think it really depends on whether people are looking for retroactive or prospective coverage. I think from a retroactive application of coverage for pandemic losses is probably untenable and would adversely affect the insurance companies. Going forward, I think there would have to be some type of government backstop for such a large and relatively unpredictable threat like a pandemic, especially now. In a sense, I think you'd look to some of the state models, particularly Florida, where you had a significant natural disaster impacts. But again, for hurricane-related coverage, just because of the costs or the federal flood insurance program, there would probably be a need for some type of governmental backstop.
Great, thank you. Another question we're getting is right in your wheelhouse. It's a lot of our smaller banks have relied on that in-person touch and meeting way of doing business, and now they've transitioned to working from home. If this prolongs and those smaller businesses or smaller banks or smaller community credit unions don't have access to those tools or services that they have at their branch outside of setting up appointments and things like that, how do you see the smaller banking industry transitioning?
Okay. First, I think I want to really praise the community banks for, and all banks actually, for their ability to actually activate their business continuity plans and to be able to continue. When you think back, they've continued banking services without interruption through a combination of digital delivery systems. The way I think they were very responsible in the manner in which they restructured their branch operations, relying where possible on drive-up facilities with the ability to schedule appointments. That's in terms of pandemic planning, banks need to ensure that they are meeting their customers' needs, but at the same time protecting their employees. And I think they've done an admirable job, and it's one of those things that you don't appreciate it, what's being done behind the scenes until it breaks down somewhere. And we've been very fortunate that banks of all sizes, particularly the community banks, have really executed exceptionally well with the initial closings required by the emergency declarations. In terms of the business model, I think everyone's business model is going to change or be rethought as a result of the pandemic. And I think institutions are going to be rethinking that how they will their distribution models, how they will deliver services, what's the most effective and safe way of doing it. For the near term, I think that smaller community banks are going to have to rely on digital means with the ability to have safe appointments arranged. But again, I do think that person-to-person contacts in all businesses and in banking aren't going to end, but we're going to, until there's a vaccine or therapies to treat the coronavirus pandemic, we're going to have to learn to try to use the digital and other means to achieve the same goals. And one of the complaints that I heard as a public official was the lack of responsiveness by larger bureaucracies, the flatter management structures and decision making at community banks will still be an advantage, even in and I certainly hope so, even in a more digitally reliant distribution system.
Great, thank you. The next question we had is whether you touched on the CARES Act and what your feelings were about the differences between how the programs have affected small businesses in the community versus larger institutions that might be across the country.
Mm-hmm. Yeah, I mean, I think the CARES Act's had $2 trillion worth of funding associated with it. I think that if you look at the way the economic or business-related funding has been allocated, you had a significant appropriation for the Paycheck Protection Program at $350 billion and possibly up to $500 billion if Congress acts with a new appropriation. But there's a Section 2003 of the CARES Act does provide emergency assistance to larger financial firms. That had I think a $500 billion appropriation. 430 billion roughly was allocated to Treasury to work with the Fed to provide backstops for mid-size and businesses in larger institutions through some of the credit facilities of the Fed under Section 13.3. You also had the specific appropriations to the airline industry, the cargo industry, and the national security related firms. So, again, I think, given the 10-to-1 leverage that the Fed programs have, you're talking, just with those programs, a potential $4 trillion impact. That's a lot of money being available to help support businesses in the short term. Again, I think the issue is going to be if the coronavirus pandemic restrictions continue longer than expected or desired. We will at some point, probably in the beginning of next year, seeing some stress on the banking industry itself in terms of capital and reserves. I think you all saw just this week how some of the larger banks have reported earnings, and many of them have made significant additions to the reserves in anticipation of future credit and other related losses. So again, I think that's going to be a function of time, how well the pandemic is addressed, and that will dictate what the longer term impacts on the banking sector will be.
Great, thank you. The next question is kind of a crystal ball question, and if you could put your legislative hat on, that would be great. Let's say money continues to run out for the PPP program. Do you see Congress continuing to kick this can down the road by funding it over until we're out of this pandemic, where there's 6 months, a year and a half? Because I have a feeling that companies aren't going to recover as quickly as other companies, and they'll still be looking for these types of funding.
Yeah, that's a great question. I'm really surprised today to see what a radical shift there's been in the use of fiscal remedies to address this crisis. When you look at what was done in the last global financial crisis. During the last crisis, you had the TARP, and you had a very relatively minor stimulus package that the Obama administration was able to get to Congress. Thereafter, I think we heard a lot about the moral and issues associated with providing direct or fiscal assistance, issues about how large a deficit the country could sustain. Today, at least up to now, we've seen none of that. There's been, really, when you look at the CARES Act, $2 trillion was appropriated in lightning speed. It'll be interesting to see if members of Congress start voicing concerns about the federal debt and the ability to fund this from a GDP standpoint. Again, I think the initial response has been to use that bazooka that former Treasury Secretary Paulson spoke about. Again, I think the appropriation on, if there is an appropriation on the Paycheck Protection Program, adding money, that'll be a signal of how willing Congress is to appropriate. There may be some statements that we can divine as to what, whether or not additional funding will be made available.
Mm-hmm. And Tom, you're right. This Congress and the Federal Reserve, if you add up all of the money that they've appropriated, it's anywhere between like $5 to $7 trillion and counting.
That's right.
It's astronomical when you think back of what you and some of your colleagues, 08, 09, and the programs that you put together, 800 billion one year, 900 billion another year. We're talking between 5 and 7 trillion, and the clock is still ticking. And there are some people out there a little concerned about what is this going to do with the impact on the overall deficit. Then there are other people who are saying now is the time to borrow as much as you can because the interest rates are so low. So it's interesting, to say the least.
Yeah, no, I think definitely, at the time, during the financial crisis, the last financial crisis, I think, and this is, I think, happening today. The initial response is let's try to keep the thing from blowing up. And I think that's the stage we're in now. I think we have, basically calmed the credit market. The CARES Act has mitigated some of the unemployment or employment issues, which are still significant with 20 million claims. But as time goes forward, there needs to be a clearer or predictable point in time where people can factor in that economic activity will increase. And I don't think we're there yet. And again, that's going to be just like in the last financial crisis, no one could value some of the esoteric assets that some of the larger banks held on their books. Now we're in a similar situation where we can't really quantify when the economic activity will resume either partially or at full capacity. And until you get to the point where you can quantify that, businesses cannot really plan or execute any growth.
Right. Other questions, Griff?
Griff is having some technical difficulties, so this is Katie with the council with one last question, asking how protections against predatory lending during this time may be created.
Yeah, I think, again, this is something you learned from an earlier crisis. I think there is a significant opportunity for abuses when you have a crisis like this, and this is where it's really important for traditional banking institutions to act responsibly as they usually do. But it is also an opportunity for the less scrupulous lenders or scam artists, and that's where consumer protection agencies like the CFPB, the FTC, and state consumer protection agencies and attorneys general need to be working and monitoring the situation. As I mentioned earlier, some of the banking agencies at the federal and state level are trying to signal that they are forbearing or being flexible on prudential and consumer protection matters. I think they have to be careful in that regard. Forbearance cannot go on forever, and you can create an environment where less desirable cultural impulses will take charge, and future issues will come to light down the road as they always do.
Mm-hmm. Well, we promised we'd have you for a half hour. We've gone over a little of the half hour. I just want to say thank you, Tom, for your thoughtful, insightful remarks. You give it a different perspective than some of our, elected officials because of your past, qualifications and the FDIC and controller. So this has been really helpful to a lot of our members on the Financial Service Committee. I can't think of anyone more of an expert on analyzing the impact on the financial industry with the virus, as well as a good analysis of the CARES Act and how any of the future policies are benefiting the financial service industry. So all in all, I want to thank you for taking time out of your schedule to be with us today. You're a good friend. You've been so supportive of the council. I want to thank you for all that you've done for us and always being available. I want to thank all of the members of the Financial Service Committee for participating. Look forward to having you on the conference call again on Monday for John Larson, the congressman from the 1st Congressional District in Connecticut. Thank Griffin Doherty and Katie from the New England Council for coordinating this conference call. And again, just remind all of you to remain safe and hopefully very healthy. And thanks for all that you do for the council.
Thanks, Jim.
Thank you, Tom.